Headline inflation was only a tenth above expectations in January. Core was in line, but it appears that markets looked at the details and came to the realization that the Fed has been trying to hammer home for months now. Bringing inflation down to that 2% target is going to be harder and bumpier than markets expected. Here's the data: 0.5 on the headline number. We're expecting 0.4, and that's up from 0.1%. The year over year did tick down, but it was one of the smallest declines we've had since the summer. Core coming in line with expectations, 0.4%. Again, ticking down a tenth, but lower than the declines we've had in that year over year rate.
Welcome to the inaugural broadcast of the Warlords of Wall Street. On this particular podcast, we're going to do everything we can to try to give you the basics of investing, try to give you some advanced tools so that we can help you grow that nest egg and better protect you for your future. Starting today with the basics, we're going to cover what happened today in the market, which was, for the most part, dominated by the CPI data. Everyone had called for 6.4 year over year. It turned out to be 6.4. Well, because that's what the market expected. Last month it was 6.5, so it was a negligible drop, which is starting to show maybe just a little bit of stickiness for inflation. The core reading came out at 5.6, just a tick higher than the 5.5 that was estimated. And I know a lot of people out there probably don't have a firm grasp on why these esoteric numbers from CPI core, consumer price index, is basically a registration of inflation. And we've all been dealing with a lot of inflation of late. You see it at the pump. You see it in the grocery store with the price of a dozen eggs. And these are the numbers, although the little invisible demon that inflation is, these are the numbers that truly affect the quality of life. And because the Federal Reserve, which has been given charge and oversight over trying to manage the American economy, they've been swinging a pretty big sledgehammer for about the last 4 months, and they've been jumping the interest rate, which had been set at zero for well over a dozen years, is now been ratcheted up to where we're pretty close to about 4% to 5% on the short-term interest instruments that the government sells, from its T-bills to its 2-year notes to its 10-year bonds. Everything is floating in that 4 to almost 5% range now, which is what the Fed intended. And by raising rates so aggressively over the last little bit, they've been trying to slow the economy as best as they can. And they've done a decent job of it, with all in the hope and effect of trying to get inflation back down to what they've been able to manage for the last bunch of years, which is a little over 2%. Historically speaking, it should be probably closer to 3 and change, but that's a discussion for another day, of the manipulation that the Federal Reserve will go through with the economy to try to keep inflation at an artificial low, because that seems to be what works best for a consumer-driven economy, which is what the United States has. We found amongst the numbers that, surprise, surprise, the reason why the numbers weren't down more, energy is up. We spoke about that yesterday, that we're seeing that at the gas pump. The prices were going down. Now they're actually going up a little bit. We're seeing West Texas Intermediate barrel of oil go up just a little bit. I think we're actually going to see a little bit more of that happening, only because for the first time in 3 years, China is committed to being fully open. And much like the pent-up desire by Americans over the last couple of years to get back out, get back to life and travel, you've got 17% of the world's population's been cooped up for 3 years. I think you're going to end up seeing them spend a lot of money and do a lot of things, including travel, which is going to drive commodities such as gas higher. So if I were playing a commodity, and we typically don't, I would be looking at some of the futures contracts on oil over the next 6 months or so. Coming back to what we were talking, inflation is going to be a little sticky. It's slowing down, but it's not slowing down dramatically. From where it was at 9, it looks like that it's on a slide down. But now, all of a sudden, because the Fed's going to continue to raise rates, although it won't be for another 6 weeks before we see another 0.25% bump. The consensus is that they'll probably bring yet another 0.25% bump in the rates. That will certainly bring the 10-year up and over 4%. That'll take the 2-year up over 5%, the target where they want to be. And that's not necessarily going to be great for the stock market. So we're going to see some volatility within, the market will probably be range bound within a couple of 100 points higher than here and maybe as much as 400 points lower. And I think that's where it'll continue to bounce around until we get into the next earnings season 90 days from now, when we find out just how well, although these are downward revised earnings expectations, how close they come to these downward revised numbers, and is it as bad as anybody speculated it would be. So far it hasn't been. Most of them been beating their expectations, and that remains a positive sign. The fact that there were so many jobs added in the last report, that was a surprise, not exactly what the Fed had in mind. Their sledgehammer economy is based in your grandfather's economic classes coming off of the post-war, to where you had to really get unemployment up so that people didn't have the money to go out and make purchases per se. And when you're not driving consumer spending and what have you, then you're going to end up having a slowdown, and that will not necessarily cause inflation to come down, because if people aren't buying the boxes of Kraft macaroni and cheese, Kraft will be tempted to start lowering the price until such a time as their sales do begin to jump. Thus far, most of the consumer brands have gotten away with raising their prices and not seeing any sales declines of a meaningful amount. So long as that remains the case, we're going to see some sticky inflation, and prices aren't going to come down as much as we'd like. The bankers came out today like they always do, and they continued to reiterate that the GDP growth looks like it's going to hang around 2%. That's pretty much what everybody thought it would be. That the consumer is looking good, better than what the bears suggested they would be doing. And that because of that, we're probably not going to see some hard landing, and certainly not some crazy deep depression. The Fed will probably, as I mentioned, bump the interest rates a couple more times, and they'll probably leave it there for the balance of the year just to make sure that they properly kill off inflation. It's a sledgehammer approach, but it probably ought to work. Yesterday, we spoke for a moment about how we liked 2 or 3 stocks that we put forward to you. The Google today, looking at the market going up and down the way it did, was essentially flat, as was Meta, which tends to confirm what we thought, is that this isn't a bad entry-level point. The Tesla that we liked yesterday actually jumped $14 a share today. So that was a pleasant surprise. Didn't expect to see a 6 or 7% jump in it so quickly, but each and every one of these, for the most part, is a longer-term hold for us, including the Tesla. It's not going to be sold anytime soon. One that caught our attention today was Goodyear Tire, so we're going to add it to our list of stocks that we think you ought to consider. Looking at it, its price-earnings ratio, its PE ratio, far too low. 3 and change. That's telling me, screaming at me, that it's oversold.